The room is quiet, but the signal is loud. The Federal Reserve is cutting interest rates again, not because everything is fixed, but because something feels weak. Jobs are slowing down, prices are still high, and inside the Fed, people are arguing in public. Some say we are cutting too soon. Others say if we wait, something might break. Here's the strange part. This feeling is not new. Almost 100 years ago, the Fed faced the same fear. They cut rates to protect the system. That choice didn't break the economy right away, but it changed history. To understand what's happening today, we need to go back. It's 1927. America looks strong on the surface. Cities are busy, stocks are rising, people feel confident. But behind closed doors, leaders are worried. Europe is buried in war debt. England is losing gold. The global banks are under stress. So leaders from the world's biggest central banks meet at a private home on Long Island. They ask the United States for help. Their message is simple. Make money cheaper. Help us survive. Benjamin Strong, head of the New York Fed, agrees. He cuts interest rates. He jokes that it's just a little shot of whiskey for the market. Just enough to keep things moving. But the US economy was already warm. And that extra shot changed everything. Here's how it worked. In the 1920s, people didn't need full cash to buy stocks. They only needed a small down payment. This is called margin. Margin means borrowing money to invest. If stock prices went up, people made fast money, so they borrowed more. Prices climbed higher, and the cycle fed itself. The market wasn't rising because companies were stronger. It was rising because borrowing was easy. Now, look at today. The tools are different, but the habit is the same. Markets have learned to expect help. When prices fall, people believe the Fed will step in. Cutting rates during stress sends a message. Don't worry, we got this. It makes risk feel smaller than it really is. The crash of 1929 didn't happen right away. First, the Fed tried to slow things down by raising rates. But the market was built on borrowed money. When borrowing got expensive, people had to sell. Selling pushed prices down. Falling prices forced more selling. The system collapsed under its own weight. Today, the danger is different. The big risk now is inflation. Inflation means prices keep rising, and money buys less. If the Fed cuts rates too early, prices can heat up again, and people may lose trust in the dollar itself. The lesson of 1927 is not that cuts always cause crashes. It's that comfort can hide danger. Benjamin Strong wanted a smooth landing, but by easing pain early, he made the future pain worse. Today, the Fed faces the same choice. History teaches us one quiet rule. There is no such thing as a free rate cut. So here's the question. When fear is in control, is acting always safer than waiting?